Good morning, good morning, good morning. I was going to say we finally made it. We made it to the end of the week, but the markets. Wait for old Brown Shoes to get on. Is he there? There he is. Invite. What a day. What a week. Morning. Hello? No, he's still not there. Come on, mate. You can do it.
Hi.
Good morning.
The one who started the call late this
Late? It was still 8:30.
morning. Oh,
Wow. Right, let me just get the legals out of the way before you berate me anymore. Where am I to go? Well, what we're doing? Oh yeah, that. Nothing discussed on this Spaces session constitutes trading advice, or investment advice, or infers any kind of endorsement by PIQ Global Limited, trading as PIQ or its affiliates, including the host, which are Mr. Brown and myself, Mr. Paisey. That's out of the way. Oh God, I'm tired.
Aren't we all, mate? It's been a hell of a week. Happy Friday to one and all, although it's probably not a happy Friday if you're an equity bull. And I think most people were hoping for a sort of quiet end to the week, and I don't think we're going to get that, the price action.
Well, I'll be Friday in about an hour.
Oh, right. Fair enough. Well, hopefully you don't run away and we can actually catch up for a bit.
Well, funny you say that. I'm actually going to Birmingham relatively soon after I get there, so we probably won't see each second week in a row. I'm not sure if you can cope.
Blimey. Well, make sure you've had your vaccinations before you get up there.
Well, I've also changed the time on my watch, setting it back about 50 years.
Oh dear.
Hello.
Right. Shall we crack on?
Right, crack on.
Can you hear me? You can.
Yeah, crack on.
Right. Good. Let's crack on. Good morning, all. As we alluded to, it was a relatively risk-off day, or very risk-off day for financial markets yesterday, and that price action has this morning. It was a brutal session for equities. The S&P 500 ending the day 1.5% lower, the Nasdaq down around 2.5%, and we have seen futures extend those losses this morning, with the S&P down another 1% and the Nasdaq down another 1.5%, and that comes the selling started after the ISM manufacturing PMI figures from the United States yesterday, which came in at 46.8, down from 48.5 and an 8-month low. I think the employment sub-index falling to its lowest level since June of 2020 at 43.4 was also likely of significant concern to the market. And then the selling really exaggerated all throughout the afternoon and into the evening here in London. And then, of course, we had some rather poor aftermarket earnings from Amazon, who delivered a top line miss and a big miss in terms of forward guidance. They were trading around 5% lower after hours. And we also had absolutely abysmal earnings from Intel. They scrapped their dividend. They're reducing headcount by 15%. They reported second quarter EPS.
Hello,
yes,
Michael.
2 cents compared to an estimate. I haven't gone anywhere. I'm still here.
You're breaking up, mate. You're breaking up. Go on, carry on.
Am I?
Yeah, you were breaking up. It's fine.
Well, I'm not sure why. Maybe it's my headphones.
The wheels have really fallen off on Friday.
Oh, they really have. The wheels have fallen off the market. They've fallen off this. It's all going
No one
wrong.
gives a shit anymore. Let's just go home. Let's just go to the pub. Fuck it.
Well, I've actually got things to talk about here. The risk aversion we saw in the equity space followed through into other markets. Treasury's rallying hard across the curve. The 2-year down around 10 basis points on the day, and the 10-year below 4%, yielding its lowest February. We also see the OAS curve now fully pricing 3 Fed rate cuts a year. In fact, the market discounting 82 basis points worth of easing this morning, which is rather overdone, I think, no matter which way you look at things. The dollar also rallied against most major peers. The dollar index closing about 0.4% higher. Some of the higher beta currencies slipping quite substantially. Cable down around 1% on the day, although it is worth noting that most of that move in the pound came, as we alluded to yesterday, before BOE decision, which is fishy. In terms of the commodity space, we saw some softness in gold.
Just quickly stop you there. So would you like to explain to some of our listeners that might not be aware what a beta currency?
Yeah, effectively currencies that are highly correlated with risk assets or with equities. So traditionally in the G10 space, we would consider that to be the Aussie and the Kiwi dollars. You'd probably throw the pound in there as well, and maybe the Canadian dollar in the mix too.
Perfect. Thank you very much.
You're most welcome.
Thanks.
Moving on from that, some modest softness coming through in the commodities space. Gold down around 0.5%. WTI crude down 1.75%, pairing some of its recent advance, despite, of course, geopolitical risk continuing to linger. And I'm sure Ryan will get onto that momentarily. In terms of other bits and bobs from yesterday, of course, we heard from the Bank of England, a very, very divided monetary policy committee down on Threadneedle Street, with the BOE voting by 5-4 to deliver a 25 basis point rate cut to 5%. Dissenting in favour of keeping rates unchanged were external MPC members Megan Green, Jonathan Haskell in his last meeting, and Catherine Mann, along with Chief Economist Hugh Pill, who it appears a cut was too tough a pill for him to
Mate, you
swallow
can't
this
use it
time
twice.
around.
You can't use it twice. You can't use the same pun twice. We've got to have rules
I
here.
can.
We've got to have rules, otherwise it all goes to pot. Right, that's a yellow card offence, that is.
It's already gone to pot, let's be honest.
Yeah, fair enough.
Interestingly, though, the BOE not really signalling too much by way of further easing, saying that they will take a data-dependent meeting-by-meeting approach to decide the appropriate level of policy restriction. They're also saying that policy needs to remain restrictive for sufficiently long. Governor Bailey's press conference was incredibly dull, to be completely honest with you. I guess the two most interesting remarks were him saying once again that a return to negative rates or zero rates, quote, unlikely, which we all know, but I'm sure there's still a few out there who are conditioned to expect us to go back there. And secondly, he was trying to, that rather spurious move that we saw in cable at 8 a.m., he was trying to claim that that was because of the Bank of Japan decision, which happened 28 hours before the move in the market, which is either a really, really poor excuse or shows the governor has a really, really poor understanding of how markets work. And I'll leave it to judge which of those it may be. A few other things from yesterday. We had earnings, of course, which we've mentioned. Amazon and Intel were dismal. Apple were pretty solid. They rallied about 2% after hours. You could say it was a sort of gala performance for them. We also
make it stop. Oh God, mate, it's a fucking Friday. I don't need it on a Friday. Give me a break.
Well, especially when you go to Birmingham as well. That's depressing enough as it is.
About it.
We also had the Bank of England's weekly repo operation, another record high there at 34 billion. No real comments or questions on that at the BOE presser, although it was interesting that Deputy Governor Dave Ramsden was saying he thinks quantitative tightening can continue up until the tail end of next year, which, you know, those repo operations would perhaps suggest it can't. And last but by no means least, if it does have any geopolitical implications, and I don't want to steal your thunder here, Ryan,
please do.
but the WSJ reporter, Evan Gershkovich, who's been imprisoned in Russia for some time, he was freed yesterday in quite a big prisoner swap. So just want to keep on the radar there in case further implications of that. But that is pretty much it in terms of yesterday's price action.
Thank you very much, Mr. Brown. I'm going to have a little bit of a Ryan rants.
Oh, no.
One thing that really pisses me off is when, sorry if everyone can hear those seagulls again, I just apologise for living by the sea. That's not what I'm ranting about. But yeah, one thing that pisses me off is when journalists ask questions to the central bankers or the governors of banks after rates, basically saying, can you tell us what's going to happen in the next meeting? Just stop doing it. They are not going to tell you what they think they're going to do in the next, because they don't know what the data is going to be. It's not their first rodeo. It's not the journalist's first rodeo. Everyone fucking knows that that is the situation. Wait for the data, because they don't know themselves what they're going to do yet. Can we stop asking stupid fucking questions? Where are we?
Do you feel better
much
now?
Better. That's a lie. I don't feel much better.
I'm glad you've got that out of your system.
I could go on and on, but
it's good. It's good to talk.
Mate, my friend up in Birmingham, he's going to have a lovely evening with me this evening. We're just going off on sideways tangents. Anyway, good day, everyone. Good day. Right. What am I doing? Geopolitical headlines via our friends at New.
Fucks if I know what you're doing, mate.
God, same old. Just a little. Well, we're not going to start in the Middle East today. We're going to break it up a little bit, just because it's just getting a bit too depressing starting off on that foot. But BHP's Escondida copper mine which is the largest copper mine in the world. The copper miners there have rejected the contract offer, paving the way for a strike, while BHP will request a 5-day government mediation period. The last time there was a strike over there, it had an impact on copper. So it's definitely, and coal prices went bid. Obviously, commodities are very sensitive to things at the moment. So I'd be definitely keeping an eye on that. If we get confirmation of a strike, I would imagine, to be honest, I've not looked at copper this morning, but I'd imagine since this news that it's been rejected, we've seen a bit of, risk premium added to the price. But if we haven't, you can expect some to be dripping in soon. Again, if we do go into a strike, depending on the length, I think the last strike, and this is off the top of my head, and I'm tired as fuck, so I might be wrong here, but I'm sure it was around the 45-day mark. And like I said, we did see a bid in copper due to that, so one to keep an eye on. But anyway, back to everyone's favourite place, the Middle East. Israel had a load of rockets fired at it by Hezbollah and Hamas yesterday. President Biden and Israeli PM Netanyahu are discussing new defensive military deployment. I believe this is in relation to the other comments that we heard, which was US officials said they are preparing to counter an Iranian attack on Israel within days. So this defensive deployment may be US kind of forward basing some assets in case that does happen. We've had Turkish President Erdogan, again, remember 2-3 days ago, he's saying that if he wanted to, he could go into Israel with his forces. Obviously, greatest thing to say when you're trying to calm down the region. But he told US, I can hear you giggling in the background, by the way. He told US President Biden that Israel does not want a ceasefire, while he added that killing of the Hamas harmed ceasefire efforts and that Israel is trying to spread conflict to the wider region. What else have we got? Oh, that's the prisoner swap. You've already covered that. I think, to be honest, that might be it. There was some. We've got the Filipino and Japanese navies are doing some drills, so expect comments after that. We know that they hate anything like that going off in their hood. I think that's pretty much, to be honest, that's all I've got on the News Squawk sheet.
Cool. Good stuff. All right. We'll move on to today then. In that
why
case,
not? Pub?
Well, sadly not, because we have it is the first Friday of the month, which means it is Jobs Day.
Yeah.
And we have the US labour market report due at 1:30 London time this afternoon. Headline non-farm payrolls are expected to have risen by 175,000 in the month of July, a modest slowdown, 206,000 that we saw in the prior month, although that, of course, pending revisions. While there is, as always, a wide range of guesses for the headline payrolls print, with the range from 70k on the downside to 230k on the upside. Nevertheless, a print in line with the 175,000 consensus would be below both the 3-month average of job gains, stands at 107,000, and below the break-even pace of jobs growth, which is around 225 to 250,000, and the rate of job gains required for growth in employment to keep up with expansion of the labour force. Other metrics in the employment reports, unemployment is expected to hold steady at 4.1%. It is worth noting that if we see unemployment rise to 4.2%, that would be a trigger for the so-called SARM rule, recession indicator. You can go and debate that yourself, whether it's a reliable indicator or not. But the trigger for that is when the unemployment rises 0.5% from the 12-month low or some nonsense like that. Basically, it's been triggered before every recession. Whether you believe it or not, I don't know. I'm not going to place too much weight on it. It's all well and good saying this rule's triggered, but yeah, the economy grew 2.8 as of the end of. So I don't think there is too much to worry about on that front. On the earnings side of things, average hourly earnings expected to have risen by 0.3% on a monthly basis, unchanged from the rate of June, although that would drag the annual pace lower to 3.7 from 3.9%, and that's primarily due to the base effects from last year can fall out of the data. On the whole, it is relatively tough to imagine the jobs report being a game changer for the FOMC, with a September cut seemingly nailed on after Chair Powell's press conference earlier in the week on Wednesday evening. Having said that, the market does seem pretty eager to jump on bad news at the moment, as we saw after the ISM manufacturing PMI figures yesterday. So we could see some knee-jerk risk aversion if the payrolls report were to surprise to the downside. Although it is worth bearing in mind, as I said earlier, the market currently pricing 82 basis points of easing from the Fed between now and December, which is a very, very aggressive pace, and it would be quite tough to justify a significant further dovish repricing just based on this jobs report alone, no matter